While the markets await CPI data for the month of December on Thursday, investors are looking for ways to avoid the sting of inflation. So how can you protect your money in this kind of environment? For more, we turn to Astoria Portfolio Advisors CEO and CIO John Davi, who joins us now for this ETF report sponsored by Invesco QQQ. Good to see you, sir. So before we turn to the ETF PPI, let's talk about what your expectations are for inflation, this all-important read tomorrow.
Sure. I think that, we'll have a softer print. I mean, the trend has been lower. If you look at a lot of the forward-looking indicators, they've been all softening on the margins. So CPI kind of being lagged, historical. I think my expectation is that we'll have a lower print. So the consensus is at 6.5. The last reading was 7.1. So, it's kind of trending in the right way. And that's what the market wants. It wants lower readings.
And John, do you expect that trend to continue then?
Well, I mean, if I take a step back, so I was pretty bearish going into 2022. I'm not as bearish going into 2023, and here's why. If I think about last year, I felt like the risks to the market were pretty symmetric, meaning that I thought inflation would be higher, rates would be higher. And it was pretty easy as a portfolio manager of what you would need to do in that scenario, right? So you'd underweight bonds, lower your duration, have inflation fighting strategies like PPI, own alternatives. And that, I think you would have had a much different portfolio experience. So we at Astoria had a best year ever last year in terms of how we did managing client portfolios, for ETF models. This year going into 2023, I don't have that same sort of conviction in the sense that I think it's more asymmetric, right? So on one hand, inflation will go lower and that's good. The bull case is also that things like we had this DEFCON 5 moment for stocks last year, right? So the average stock was down 25%. The average tech stack was down 35%. Unprofitable tech down 60%. So it's hard for me to see two back-to-back DEFCON 5 years where, the average stock's down 30. But the bear case for me is that, the terminal rate, is probably going to stay stubbornly high this year. And if you talk to some Fed governors or if you listen to what they're saying, 4% terminal rate, maybe even 5%. So I think that's a problem. So I think for investors, you kind of have to barbell your portfolio and start to tilt away from, the last decade's trade, which is large cap core beta. And that's kind of what we do with PPI. PPI is really like an amalgamation of what we think portfolios should be structured going forward.
Yeah, tell us how PPI has performed in this environment and your prediction moving forward this year.
Yeah, so PPI last year was a good year. It was up 4%. S&P down 20. This year it's up about 3.5%. S&P up about 3% too. But in my experience, I've seen commodities, kind of energy equities trading at 25 times earnings, and it's just a very unusual period now. Where remember, for the last decade, nobody wanted to own cyclicals, nobody wanted to own commodities, commodity equities, natural resources. So if your view is that inflation is going to be stickier and higher for longer, which is what our firm view is, I think that bodes well for PPI. And I think there's still a very valuable place for it in people's portfolios. The PE ratio is, 8. So S&P multiple is at 17. So you've got this margin of safety in PPI.
Yeah, John, the top holdings are in your fund. CNH Industrial, Steel Dynamics, Nucor, Marathon Oil. So a bit of a mix there. As we do see CPI and PPI begin to cool, like we have been talking about, how do you shift your strategy, your investment strategy within the fund then to accommodate the growth or the easing that we are seeing in 2023 potentially?
Yeah, so very good question. So I think inflation is highly nuanced, right? So you got to have this kind of skilled active manager that can kind of move along different sectors and asset classes depending on where we are in the inflation cycle. So, for us at Astoria and what we've done in the PPI, the Access Inflation Sensitive ETF, what we've done, in recent months is we've shifted, so we sold some of our equities. We had at one point, 35% energy stocks. It's now down to 17, 18, right? So I'm somewhat worried about the energy sector in the sense that, it's this crowded, kind of consensus long. We increase our exposure to precious metals. Gold is a big hold in. Gold historically always does well in a recession. Recession risks are increasing. I think you've got this, tailwind with crypto blowing up. I think that's good for precious metals. So I think that's something that we're doing also, also within PPI, we're going overseas too, right? We're owning international stocks. So between banks, energy, industrials, materials, the four sectors that nobody wanted to own, that's very underweight in most 60/40 portfolios, along with owning commodities, commodity equities, tips are interesting. They're positive yielding now. So that, kind of amalgamation of what we think should be in people's portfolios and how they should be tilted, is kind of what we're trying to do in PPI.
All right, good stuff. John Davi, thanks so much for joining us here this afternoon.